started. So where we had stopped off in the previous lecture was with we went up until the manufacturing, non-manufacturing costs associated with a manufacturing organization. We worked through the example within the learning unit, so that was example 4.1. And then we also worked with question 4.1, which was the table on page 107. So that basically took us through halfway, just over halfway actually, of learning unit 4. So the second half of the learning unit is now looking at it from perspective of your fixed and variable costs, basically looking at the cost behavior of the different type of costs we come across and how it changes according to the level of activity. And in the first half of the learning unit, what we looked at already is all of your costs in terms of manufacturing and non-manufacturing. Remember, we saw that there are certain categories within each one of those. So with your manufacturing costs, we had your direct material, direct labor, and your manufacturing overheads. And then with your, sorry, I'm just trying to go back to the slide to just take you through a quick recap. So remember, we saw that your three categories here of your manufacturing costs: direct material, direct labor, manufacturing overheads. And we looked at the example 4.1 in your textbook where we had needed to allocate a specific cost to each one of these categories. And then under your non-manufacturing costs, we saw that you had your general admin costs and your marketing, selling, and distribution costs. So remember, in terms of allocating these to their relevant headings, you have the factory and you have an office space. That's very important in being able to identify where the cost is allocated. So with businesses that are producing the goods that they sell themselves, you have the factory where they are producing the goods itself, and then the office space, which is where your general admin, your marketing, selling, and distribution costs come in. And then we looked at question 4.1 as well in your textbook, and this is a typical type of question. So please make sure, sorry, not question 4.1, question 4.2. Page 106 and 107. This is a typical type of question that you will come across in your test or your exam, an excellent indicator of how you could possibly be tested for this section, where they have given you a table with a whole host of transactions or costs, and each one of them needed to be put into the correct category. So you had columns with headings of your direct material, direct labor, manufacturing overhead. Those were your manufacturing costs. And then your non-manufacturing costs, your general admin and marketing, selling, distribution. You'd have to put it into the correct heading and you'd have to calculate the correct amount. So we went through that entire example, and it is, as I said, very important that you read through the initial information that is given to you, those paragraphs before the question itself, because it has vital information pertaining to the question. Yes, question 4.2 on page 106 and 107. So we went through all of that in your previous lecture, and we actually stopped at that point. So the next thing we're looking at now is, like I had said, your fixed and variable costs. So apart from being able to categorize a cost involved in the manufacturing process as either manufacturing or non-manufacturing, we can also categorize it as being either fixed or variable in nature. So this falls under the heading of cost behavior, which you will see at the top here. So cost behavior is saying to us that we're basically looking at how our costs change with the level of activity. So basically saying if we increase production or we decrease production, how will this impact the fixed and variable costs? So please highlight the definition in point 3 here. It says that a cost behavior refers to how costs will react or respond to changes in the level of business activity. You will find that some costs will stay the same regardless of the level of activity, whilst others will change depending on whether your activity or your output is increasing or decreasing. So let's have a look at these. The first one is a fixed cost, and these are costs where they will remain the same regardless of how many units are being produced. So an example of these, and it's not limited to this, but it's just a couple of examples you could possibly come across, is the rent that we pay, for instance, or taxes that we pay, or insurance that we pay for, where for instance, rent, if the rent in the factory or for the factory premises is 40,000 Rand a month, it will remain as 40,000 regardless of whether we're producing 10 units or 100,000 units. It's a cost that remains the same regardless of the level of activity. And the only thing that changes here is the total cost itself of the 40,000, for instance. That total will remain the same at 40,000. Like we said, regardless of whether we're producing 10 units or 100,000 units. However, what will change is the per unit cost, because the total of 40 stays the same, but the fixed cost per unit will change depending on whether we're producing more or less. So if we're producing 10 units only, we're basically saying take this 40,000 and spread it over the 10 units that are being produced. Whereas here, if we're producing 1,000 units, sorry, I was supposed to write 100,000, but it's fine. If we're producing 1,000 units, we're now taking the same 40,000 Rand, and instead of just spreading it over 10 units, we're now spreading it over 1,000 units. So here it makes a difference in terms of the fact that the level of production had changed, and this would obviously then impact the per unit cost, whilst the sorry, it would impact the per unit cost, whilst the total cost remains the same, where it is here 4,000 Rand per unit if it was just 10 units, where it is 1,000 units, it is 40 Rand per unit. So you can see that the more we produce, the lower the fixed cost per unit will be, but the total remains the same. Compared to if it was just 10 units, the total remains the same, but the per unit cost is much larger, where we're only spreading it across 10 units as opposed to 1,000 units. So this is your fixed cost and how it works, summed up. Then we have your variable cost on the next page, and with your variable costs, it's literally the opposite. Here, it will change depending on the number of units being produced. And a typical type of example of your variable cost, and we did see this when we went through your material and labor and so on, is direct material. Direct labor, they will change depending on the number of units being produced. The more we produce, the more material we require, or the more labor hours we require, and that in turn drives up the total cost. So with your variable cost, it either moves upward or downward depending on your production levels or your output levels. So the more we produce, the higher the cost; the less we produce, the lower the cost. Here, as opposed to what I had just explained to you just now with your fixed costs, the total remained the same with the fixed cost, but the per unit, as we saw here and here, had changed. And this was because we would take that total of 40,000 Rand, and if it was 10 units that were being produced, we spread it over 10 units, and that gave us a per unit cost of 4,000 Rand. Then if we had increased our production to now 1,000 units, the total still remains the same as 40,000, but we're now spreading the 40,000 over 1,000 units, which gave us 40 Rand per unit. Here it's the opposite with your variable costs. Here the unit costs remain the same, but the total will change depending on your level of activity. So here, if for instance the material that we're using costs, let's suppose direct material costs 25 Rand per unit. Here, the 25 Rand per unit as a unit cost remains the same, but if we're producing 230 units, then we're going to say 230 units times 25 Rand each for the material, and that would give you an answer of 5750. So 5,750, as opposed to if we're producing 106 units, it would now just be 106 units multiplied by 25 Rand a unit, and that would be 2,650. So as you saw here, we had a decrease in the variable cost because we went from producing 230 to 106 units. And so in line with the decrease in the number of units being produced, it also had resulted in a decrease in the variable cost itself. So here, the less we produce, the lower the cost will be. And it would also work in the other direction, where the more we produce, the higher that cost would be. So with the variable cost, the individual per unit cost will remain the same, but the totals change. And with the fixed cost, it's the opposite. The total will remain the same, but the per unit costs will differ. So that's summarized for you in the table at the bottom here. And that's just saying to you that with your variable cost, which is the one we just looked at, when production increases, the per unit cost remains the same. And even when production decreases, the per unit cost remains the same. But the total will increase because production is increasing, so costs increase together with it. And when production is decreasing, then the costs also decrease together with it. Then with your fixed costs, the totals remain the same, as you can see, regardless of whether production is increasing or decreasing. And then when production is increasing, that total is spread over more units, so the per unit cost decreases. And when production is decreasing, we're now spreading the same total over fewer number of units, so that is resulting in a per unit increase. So let's have a look at very quickly the diagram on page 109 of your textbook. I will project it here for you as well. Just a quick visualization of your um, costs. So here is what it looks like. So this is just a graphical illustration of your fixed and variable costs as well as your total cost. So it says these costs can also be depicted in the form of a line graph as follows. You have your cost on your y-axis, as you can see here, and then on your x-axis you have your output. So as your output is increasing, you can see that firstly your fixed cost, which is this line going across, remains the same. So the fixed cost in this case is 40 Rand. I'm just going to write it next to it here. It's 40 Rand. Well, I'm assuming it's in rands. So, sorry, in it's 40 Rand and not 40,000 and so on. So we'll just say that it's 40 here for your fixed cost. It remains the same whether you're producing 0 units, as you can see here, or whether you're producing 150 units here. That cost remains the same at 40 Rand. Then you have your variable cost, which is the one starting at the origin. Here it is saying to you that your variable cost starts at zero, because if you're producing 0 units, then there would be no cost. Unlike a fixed cost, where if you're producing 0 units, your rent, for instance, would stay the same at 40,000 Rand. Here, with the variable cost, if you're not producing anything, then there is no variable cost. So it always starts at the origin and then it moves in an upward direction, because of the fact that when volume increases, it increases. When volume decreases, then it will decrease as well. So it moves in an upward direction. It's an upward sloped diagram graph for your your variable cost. So that's the variable cost graph. And then your total cost is the sum of both your fixed and your variable component. So your total cost is made up of your fixed cost plus your variable cost. And for this reason, instead of starting at the origin, it always starts at the same point as your fixed cost curve. This is because there will always be a fixed cost associated with that specific level of activity. And then anything above that is then the variable portion. So this is the 40 that's fixed, basically, we're saying here, plus then anything that you produce over and above, whatever your level of production is over and above that 40 Rand, that would be the variable component. So please make note of this diagram, just explaining to you how what your cost curve looks like, your cost curves look like. And then the next thing we're looking at, and please can I ask that you follow below this paragraph, oh, sorry, you follow in the paragraphs below this. I just want to have a look at this and see if it's on the slide. If it's not, then you can just follow in your textbook. Okay, so just follow in your textbook for now. We're looking at the paragraphs below the graph that. No, the graph will stay the same. There won't be a different graph, because remember, with this graph, we're basically saying that, I just want to clear that for you. Okay, so we're saying that when production increases, the cost will increase over time. But if production decreases, it's just saying to you that the graph would be somewhere in this direction. You don't need to change the graph, because it would just be plotted at a different figure. So for instance, here, where instead of looking at an increase in production, which would be reflected by maybe this point, we just look at a point lower on the graph, because this graph shows you both when production is at higher levels and at lower levels. Okay, so let's have a look at those two paragraphs at the bottom of page 109. These are explaining to you two concepts that you will come across. It's also something that's very commonly asked as a theory question. It's the difference between something called a semi-variable and a semi-fixed cost. Now, we know what a fixed cost is, which is one that remains the same regardless of the level of production. And we also know what a variable cost is, which is one that will change with the level of production. So it increases if production increases and it decreases if production decreases. Now we're looking at a semi-fixed and a semi-variable cost. So let's have a look at the definition of those on page 109. Please make note of it. So the first one is 4.2.9.1, the semi-variable cost. So a semi-variable cost is a cost that firstly has a component of both variable and fixed costs. So it says these costs contain both a variable and a fixed cost characteristic, and they will change with the level of production. So they will fluctuate but it's not in direct proportion to the volume created. What this means is that a portion of this cost, a semi-variable cost, will be fixed in nature, and then over and above that, it will be variable. Now, an example that they've given to you here, and I'm going to explain this example so that you're able to understand it in the context of a semi-variable cost, is a telephone charge. So normally you would have, they would state to you on a contract, whether it's a landline or a cell phone contract, that you have a fixed cost of maybe 50, okay, let's just say 100 rand. They would say to you, the fixed cost is 100 rand, so you can use the telephone line to make calls up until 100 rand. But if you are going to go anywhere, if your calls go anywhere beyond this 100 rand, it is now going to vary. So you have a limit of 100 rand, and then anything beyond this will obviously be dependent on how often you make calls, how many minutes the calls are for. It will vary dependent on what your usage is. So this is a perfect example of how a semi-variable cost works, where up until a certain level, like here we have the cutoff of 100 Rand, you have a fixed cost that will be the same regardless of how much, of how many calls you make. So you can make however many calls up until the 100 Rand is finished. Once you've reached the 100 Rand limit, then over and above that, it depends on how many calls you're still making, how long each call is, and it will obviously vary like that. So this is an example of a semi-variable cost. Then you have a semi-fixed cost below that. So with a semi-fixed cost, they say to you that this is also one that has both components of fixed and variable costs. But how this works is there's a certain range where you'll have a fixed cost applicable. And once you reach the end of that range, it will rise. The cost will rise, and again, that new cost will be for a certain range. Once you reach the end of that range, it'll again increase and it'll continue like that. So they do give you an example here, but you can read through that on your own. I would like to give you an easier example for you to understand how a semi-fixed cost works. So let's suppose that you had a truck that could be hired out to transport a certain material. So the owner of the truck or the service provider says to you that if you are transporting material that is between 0 and 5,000 kgs, the cost is to hire, let's say, 1,200 rand. Then if your kgs, the amount of material being carried, goes between 5,001 kgs and 10,000 kgs, then the cost is going to increase, and it would now be, let's suppose, 2,000 rand. Then if you're going to have between 10,001 kgs and 15,000 kgs that needs to be transported, the cost would be 3,100, and so on. You'll continue like that, where it's just dependent on the amount of material that is being transported. And let's just stop here at maybe 4,300. Okay, so here, as you can see, the cost is fixed for a certain level of activity or for a certain usage. So here you have between 0 and 5,000 kgs, any amount of material that falls within that range, it's going to cost 1,200 Rand to hire out that vehicle or that van, truck. Then if the material is heavier than that, so now you have a new range. If it's between 5001 kgs and 10,000 kgs, now you have a new fixed level. The cost increases to 2,000 and it will stay at 2,000 as long as it falls between 5001 kg and 10,000 kgs. Then again, it's basically a step each time, where for a certain level of activity it stays the same, then it increases and stays the same, then it increases and stays the same, and it increases and stays the same. So like we saw here, it was 1,200 if it was between the 0 and the 5,000 kgs. Then from 5,001 up until 10,000 kgs, it had increased to 2,000 rand to hire the truck. Then again, from 10,000 to 15,000, it increased. So anything between those two figures, so any kg amount of material between 10,001 and 15,000 would cost you 3,100. And then up until 20,000 here, it's going to be 4,300. So like that, you now have seen that it stays the same for a certain level of activity, it's fixed, but once it reaches a certain limit or a certain end of range, then it will increase and it'll stay the same again for a certain range, and then it will increase again, and it continues like that in steps. So that is your semi-fixed cost. Any questions here before we move on? Okay, so let's look at example 4.2 in your textbook. So again, it is up here on the screen. You can follow here or in your textbook. It says to you, Zondia manufacturers signed an agreement to lease property for manufacturing purposes at an amount of 14,500 Rand per month. So that's quite important. This is the value of the lease. So this is basically the rent that we're paying or the fixed cost. Remember, this rent or lease that we're paying towards under your fixed cost, we saw an example of it included where rent will stay the same regardless of the number of units being produced. And you will always ask yourself that. If you're looking at a question where they want you to classify the cost as being either fixed or variable in nature, always ask yourself the question of, can this cost change depending on the number of activities, or will it stay the same regardless of how many products are being produced? If it stays the same regardless of production, then it would be a fixed cost. If it will change depending on the number of units being produced, then it would be a variable cost. Okay, so here back to this question, it says to you that it is payable monthly in advance as from the 1st of June 20.7. The agreement clearly stipulated that the premises may not be sublet to a third party, blah, blah, blah. Then they said to you that during the period of the lease, Zondi manufacturers recorded the following production outputs of their single product, which is a glass ashtray. Notice how the fixed cost per unit in the right-hand column rises and falls as the level of activity changes. So here we're looking at how the fixed cost is affected by the level of production. So in the first table, they said to you that these are the months of the year from June 20.7 up until May 20.8. They told you that these are the number of units produced as well. Here, then the fixed cost was 14,500 Rand, and that total figure of 14,500 would remain the same regardless of how many units are being produced. So the total remains the same, but now the per unit fixed cost can change. Remember, I had given you the example of the 40,000 Rand rent being split between 10 units or 1,000 units. This is applicable here as well, where if you are producing more units, then you're spreading the total fixed cost over more units, which leads to a lower per unit cost. And if you're taking that same amount and spreading it over fewer units, then it results in a higher per unit cost. So let's have a look at it in the last column here. How they calculated the figures of the fixed cost per unit. Remember to bring anything, and I explained this to you in the last lecture as well. Anything per unit is calculated as the total divided by the number of units. So in this case, sorry, it's a fixed cost. So it's a total fixed cost divided by the number of units produced. So here the 14,500 is divided by, for the month of June, 20.7, the 1,500 units, and that gave you 9.67. Then 14,500 divided by 2,500 units gave you 5.8. Then 14,500 divided by 2,000 units gave you 7.25. And you'll continue like that. 14,500 divided by 1,000 gave you 14.5, and so on. So you'll take the 14,500 and divide it by each of the number of units being produced for each month, and that gave you all these answers at the end. So here with your fixed cost, as you can see, when production increases, then you're going to have the costs being spread over more units, so it will be a lower value. So if you look at these 2 months, for instance, June and July. For June, we had produced 1,500 units. In July, we had increased that to 2,500 units. So the 14,500 was split between 1,500 units first, which gave us the variable cost of 9.67. But then we took the 14,500 and spread it over more units. So we spread it over 2,500 units, which is 1,000 more than the previous month, which means that we would have a lower per unit cost. Again, we did see that because it gave us 5.8, which is just saying to us that instead of spreading that total amount over a fewer number of units, we're now spreading it across many more units, which is decreasing the cost per unit. So that's your fixed cost. As you can see, it will change. It will vary depending on the number of units being produced. So the per unit cost will increase when we are producing fewer goods, and it will decrease when we're producing more goods. So I'll write that at the bottom here as well. So your fixed cost per unit will increase Please make sure you're taking this down. So it will increase when we are producing less. So producing less because now we are spreading the total over fewer items. So we're producing less, which means that the total is split into fewer items, which increases the cost per unit. And it will decrease when we are producing more. So the more we produce, we can take that amount, spread it over the greater number of units, and this would bring our cost per unit lower. So producing more. Okay, so that's your total fixed cost. Then your variable cost on the next page is the complete opposite of this. Your variable cost, like we said, will increase with the level of activity, and it will decrease with the level of activity as well. So the more we produce, the higher the variable cost will be. The less we produce, the lower that cost will be. So here again, you can follow in your textbooks as well. So it's for some reason taking a while to load on the screen. So here you can follow in your textbook page 111. The variable cost per unit in the last column of the second table stays exactly the same. The variable cost per unit is 5.80 in this case, and it will stay the same regardless of your level of production. That's the variable cost per unit. So the variable cost per unit stays exactly the same. The total variable cost does change. So your total variable cost will be higher when there is a higher level of production, like we saw here. So here it is here. This last column remains constant. So constant, that will remain the same. These will change because of your level of production. Where you went, for instance, from 1,500 units being produced, where it's 1.5 times the 580, that gave you a cost of 87. But now when we increased volume to 25 times the 58, that was 14,500. Then we decreased the production to 2,000. So that's 2,000 times the 580. So that was a decrease of, sorry, a decrease to 11,600. And it will continue like that. When you increase, the cost will increase. When you decrease production, the cost will decrease. Okay, any other questions here before I continue? Okay, so you can go off on a break. When you come back, I will continue with the content as well as the example in your textbook of fixed and variable costs. And then we'll also work with the additional example in your textbook based on your fixed and variable costs and allocating them to the correct category and calculating the value as well. So you can go off on a quick break. Okay, let's get started again. So the next thing we're looking at is still within your fixed cost, your cost behavior, variable fixed cost, is something called your break-even analysis. So I'm sure you have come across this previously, how it works, but where we're bringing it in here is once we have calculated our fixed and variable costs, we're then going to use that to calculate your break-even point. And then in terms of your break-even point, even further to this, we look at the values that make up the calculation. And each individual value is also calculated using a specific formula. So we're going to look at overall what will need to be calculated. So we said that we'll need to look at our fixed costs, we'll need to look at our variable costs, then we'll bring that into your break-even formula. We're going to look at the components that make up the break-even formula and how each one of them can be calculated. And then we're going to look at the formulas for each one of them, how they're calculated, and then calculate the break-even point as well as the break-even in sales. So your break-even analysis is looking at, firstly, what break-even is where, remember, when a business is not making a profit or a loss, it is termed break-even. So when a business's profits are, when a business is not making a profit, when their income is equal to their expenses, this is regarded as the break-even point. So you can highlight that here in this point as well. So it says at the break even point, the income generated from the sales will equal to the expenses that are incurred. So income is equal to expenses at the break even point, and this is used, as I said, overall. It's used in something called your cost volume profit analysis. What we're looking at in a cost volume profit analysis is all of the costs being incurred, literal to the words. So this is all of your fixed and variable costs. Then we need to look at the volume that needs to be produced in order to cover those costs. And then at what point do we start to make a profit once we have accounted for all of our costs? So your cost volume profit analysis is where we do exactly that, what I had mentioned to you just now. We identify these are all of the fixed costs, these are all of the variable costs, and then we use that to determine your break-even point, where we are now looking at the volume that needs to be produced in order for us to cover those costs. And then over and above that is now where we start to make a profit. So we're looking at all of this in the next couple of slides. We're breaking down each of those formulas and looking at what goes into them and how it is calculated. This is also something that's very commonly asked as a practical application type question. So please do pay careful attention. This bit at the top, you can read through that on your own. It's just theory regarding your break-even analysis. I'm not going to go through that here. The only one that I'm going to go through is this point. It says to you that a business needs to consider, when carrying out this break-even analysis, something called the margin of safety. You do need to know the definition of the margin of safety, and you'll see that in the next learning unit, you'll look at how it's actually calculated as well. But for this learning unit, you just need to know the definition of it. So the definition of your margin of safety is the extent to which a business's sales can decline without the business suffering losses. So, your margin of safety is saying to you, in terms of numbers and helping you to understand this better, is if your break even point, let's suppose we calculate the break even and it is 2,000 units. And let's suppose that a business is currently sitting at 8,000 units being produced in a particular month. They're saying to you that the margin of safety is this portion here from the number of units that are currently being produced up until the break-even point, where it's basically saying the difference between the 8,000 and the 2,000 units, which are 6,000 units. It's saying to you that production can decline up until 6,000 units. So we can produce 6,000 units less. But once we reach that mark of 6,000 units less being produced, after this, if we go to 6,001 units less being produced, we'll now start to incur losses. So your margin of safety is saying to you that the business is safe up until the point where production decreases by 6,000 units. But beyond 6,000 units, if it's now declining by more than 6,000, then you're going to have a problem because now the business is going to start to incur losses. So it's just literal to the words a margin of safety. It's sort of a safety net in place saying to you that if production decreases and the company is performing badly in a particular period, the business is safe up until the point where production decreases by 6,000 units. So if it is declining by 4,000 units, if it's declining by 2,000 units, if it's declining by 4,500 units, it's fine. The business still will survive and they'll still be making a profit. But once it's now reaching 6,000 or goes beyond 6,000, so if it's now producing 8,000 in a general month, but it has decreased to maybe, let's say, 8,000 units is what it was producing, it now had decreased in production by 6,500 units. That would mean that their production is now currently sitting at 1,500, which is below the break-even point of 2,000 units. And anything below the break-even point is saying to you that the company's income is less than their expenses, which means that the company will now be facing losses. So this is what your margin of safety tells you. But again, at this point, you're not looking at how to calculate it. It's just for you to be able to understand what it is. Okay, so that is your margin of safety. Now at the bottom, let's look at some of the items that you're going to come across in your break-even calculation. The first one of them is called your marginal cost. This is also just known as your variable costs because it's the sum of all of your variable costs. So please make note of that. So your marginal cost is also known as the sum of all of your variable costs. So we also just call it your variable costs. So variable cost. And these are all of the costs that do change with your level of production, as we had said, since it is called a variable cost as well. And this is expressed as a cost per rand of turnover. What we mean by that, and I'll come back to this at the top just now, so ignore this for now. What we mean by that in terms of the ratio, the marginal cost ratio is where we express the variable cost or the marginal cost per rand of turnover. So there's three different formulas that we can use depending on the type of information that we are provided with. If we're given totals, then it will be the total marginal cost over the total sales. If we're given per unit figures, then it'll be marginal cost per unit over the selling price per unit. So overall, the marginal cost ratio is your marginal cost over your sales multiplied by 100. It is expressed as a percentage, so please make note of that. Most of the time we just leave it as a percentage, but sometimes if we are interpreting, we can leave it as a decimal as well. So let's suppose we calculated this marginal cost ratio and we had an answer of, you'll see here at the bottom, 0.6, or as a percentage, 60%. What that would mean is that 60 cents of every rand, or 60% of your total turnover, is allocated to your variable costs. So 60 cents of every rand worth of sales is attributed to your variable costs. Or you can say that, so I'm just going to write it here. So your sales figure, 60% of it, or the if you had a figure of 60%, 60% of the total sales would be allocated to our variable costs or our marginal costs. Or you can say 60 cents out of every rand worth of sales is going to be allocated to your variable cost. So this is how we look at your marginal cost or your variable cost. Then on the other hand, whatever is not paid in the form of a variable cost is going to be the income that the business will make. So this is called the marginal income, which is a bit at the top here. So your marginal income is also called the marginal contribution, or it's also called the contribution margin. You'll see we'll look at this a lot later on and also in Finance 2B. So the contribution margin is now saying to us that once we have looked at our total sales and we have subtracted all of the variable costs, whatever remains is now the actual income or profit that we have made. So here, your marginal income is then the difference between your sales and your marginal or variable cost. So once we've removed all of the marginal or variable costs, whatever remains is referred to as your marginal income. So here, your marginal income is calculated as again, depending on whether we have totals or per unit figures given to us. If it's a total, it'll be the total marginal income over the total sales. If it is per unit, then it'll be the marginal income per unit over the selling price per unit. And overall, it is multiplied by 100. So again here, if we get an answer of 0.3, for instance, that would mean that 30 cents out of every rand worth of sales is the marginal income that the business will make, or 30% of the total sales is the marginal income. Remember, the marginal income is calculated by taking your sales and subtracting all of the variable costs. So I'm going to say here all of the variable costs, and then whatever remains then is your marginal income. So we're going to use those as well in our calculations. I'll come back to the calculations just now. This is just a repetition of something we had done in Learning Unit 1. It's your net profit ratio. So your net profit ratio is your net profit over sales multiplied by 100. The reason that it's repeated here is because you'll see when we go through, I think it's question 4.3 in your textbook, we'll need to know that for some of the calculations there, but it's literally just a repetition of what we had done in Learning Unit 2. Then on the next page, we have now your break-even point formula. So your break-even point can either be calculated in terms of units, so the break-even units. And remember, break-even is telling us that this is how many units we need to produce in order for the company to be able to meet its costs. So at this point, your break-even, here the business is able to cover all of their costs, and anything above this is where they will start to make an income or profit. Anything below it is where they will start to make a loss. So your break-even point is literally the point at which the business is able to cover all of its expenses. So at this point, income is equal to expenses. And as we said, anything above it is where they are going to make a profit, because now they have covered all of their costs, and any additional production is going to be a profit, and then anything below it is where they're going to start to make losses. So here, the break-even point in terms of units being produced is calculated as the total fixed cost over the marginal income per unit. So your marginal income per unit, remember, I said to you on the previous page, is calculated by the selling price per unit because it's per unit in the denominator minus the variable cost per unit. So that's your break even in units. Then it can also be calculated in terms of sales revenue. So in terms of sales revenue, it can be calculated by taking either one of these formulas can be used. So the first one is taking your total fixed cost and dividing it by the marginal income ratio. The marginal income ratio is, remember, the marginal income per unit divided by, so marginal income per unit divided by the selling price per unit. So if you're using that formula, then your denominator is a fraction of its own, where the marginal income ratio is your marginal income per unit over your selling price per unit. And then you have the total fixed cost divided by this. And then the alternate formula is whatever answer you got from the first question, this break even point in units, you'll take that, here it is here, and you will multiply it by the selling price per unit. So you would first have to work out the number of units that are being produced. You'd first have to work out the number of units for your break even point, and then take that and multiply it by your selling price per unit. So either one can be used. Generally, the easier one of the two is to just use the one at the bottom, because most of the time you already have your break even point in units calculated. So you would just simply take that break even in units and multiply it by your selling price per unit, and that would give you your break even in terms of sales revenue. So let's look at example 4.2, sorry, not 4.2, 4.3 in your textbook. So this is, I have it up on the screen, so you can either follow in the screen or in your textbook. It's exactly the same thing. This example is based on the information that we had used in example 4.2. So let me just show you where we're getting the information from. Remember, we worked with this example in the last lecture. So we're using the exact same information, and I'm not going to go through that again. Okay, so this example we worked with, example 4.1, remember it was based on Letsema furnishers, and we did the entire example here. We calculated what the direct material cost was, what the direct labor cost was. Here's the direct material, here's the direct labor. These were all of your manufacturing overhead costs, all of this. Then we did your non-manufacturing costs, where these were your marketing, selling, distribution, and then your admin cost was here. And then we had also totaled everything up here. So we're using the same information from this example, but now we are putting it into the categories of what is variable versus what is fixed in nature. So let's have a look at that example. So the first item that we had come across in terms of your costing, and I can work with it here since I'm already on this page. Oh, sorry, let me just... Okay, so you can follow in example 4.1 in your textbook and then look at the screen for the solutions for the example that we're working with now at the moment. Okay, so from example 4.1, the first item that we had come across was your material. Your material, and we said your labor as well, both are variable in nature. So here, these are costs that will change with the level of activity. So I said to you, always ask yourself if you're ever given this type of question where you are required to classify these as either fixed or variable in nature, and then you're required to calculate break even points and so on. The first thing you're going to do in terms of categorizing them is ask yourself the question of, does this cost change with the level of activity, or will it remain the same regardless of how many units are being produced? So here the first one, which is the wood that is used in production. This was the direct material. This would be a variable cost because the more we produce, the more material we'd need. The less we produce, the less material we would need. So this 120,000, we already calculated in example 4.1. So I'm not going to calculate it again. This would have been a variable cost. So it's going to go into the heading of variable costs. Then you have your labor. So your labor was 80,000 Rand, and it also changes though with the level of production. So the more we produce, the higher this cost will be. The less we produce, the lower this cost will be, because that would mean that we would need less labor hours, which would give us a lower cost. And so that would be a variable cost as well. Then we're looking at the next item, which is the factory foreman's wage. So here, a foreman in the factory, his wages would remain the same regardless of how many units are being produced, because he is not a person. Remember, when we had discussed this in class, we said that with your labor workers, your direct labor, these are the people that are actually producing the goods that are being produced, your direct labor. So here, if we needed to produce more units, we would need more hours, or we would need more people to be employed in order to produce the higher volume. However, with a foreman, a factory foreman, you don't need to now employ more foremen. You don't need to now, depending on the fact or that we are either increasing or decreasing production, it's not going to alter the wages that the factory foreman gets paid. He will get paid regardless of whether the company is producing 1 unit or whether they're producing 1,000 units. So his salary will remain the same, and this is why it is classified as being a fixed cost. Then the same, and we had discussed this already with your rent and your rates and taxes. These will remain the same regardless of whether we're producing 1 unit or 1,000 units again. They won't change depending on your level of production. If our rent is 4,000 Rand for the factory, then it'll still be 4,000 Rand even if we produce nothing, or even if we produce 100,000 units. So this classifies it as being a fixed cost. The same with rates and taxes as well. It will stay the same regardless of the level of activity. So it will be classified as a fixed cost. Then you have the sales representative's commission. Here, you're looking at, will it change if we're producing more units or less units, or does it stay the same? So commission is based on the volume produced or sold. So that would definitely be a variable cost, because the more they sell, the higher the amount of money they will make. The less they sell, the lower the amount of money they will make. So this would be a variable cost. Then you have your advertising costs. So again here, advertising costs, ask yourself the question, does it depend on how many units are being produced? If we produce more or less, will this cost change, or does it remain the same? So again here, this is a cost that remains the same regardless of the number of units being produced, and so it will stay the same at 4,000. Sorry, guys, can you hear me now? Okay. Can someone tell me at which point you stopped hearing me so I can retract a bit? Okay, perfect. So let me go back to the item here. So I stopped at the advertising cost. So let's start with it says to you the girl who was employed on Fridays and her salary. So when we had done this example 4.1 in class, the example had said to you that there was a girl that was employed on Fridays and she worked for the company already. On an ordinary basis, she would earn a salary of 5,000 Rand. But since the company had started the production of this new unit, her salary increased to 6,000 Rand. So she would receive an additional 1,000 Rand when they took on this project, when they took on the production of this new item. But you will ask yourself the question of will her salary change depending on the number of units produced? And this is just the same as with your factory foreman's wages, where the salary that this person is getting paid is not depending on how many units are being produced. She would still be paid the additional 1,000 Rand if they produced 5 units, or if they produced 100,000 units. Should still only get an increase of 1,000 Rand. So the figure itself is not going to change depending on the number of units being produced. It is a fixed cost. Then the same with your wood polish and your glue and nails. You're going to ask yourself the question of, do these figures depend on production or not? Now, I'm grouping them because they both fall under the category of your indirect materials, but they work in the same way, or they're viewed with the same mindset as your direct material right here at the top. The idea is if we are producing more units, then we need more glue and nails, or we need more wood polish. So here, if production is increasing, then we would need more of these items, which means that their cost will increase as well. So these would also be a variable cost because the more we produce, the more we need, the less we produce, the less we need, and the lower the cost will be. So it is a variable cost. Then your insurance, it also falls under the category of fixed costs because here we're saying that insurance will be the same if you have a premium on your insurance of 1,500 Rand. It does not depend on how many units the company is producing. It will stay the same as 1,500 whether they're producing nothing at all in a particular month. They'd still have to pay the 1,500, or whether they're producing 5,000 units, it would still be 1,500 Rand that they would need to pay in terms of insurance. And then you have the quality controller, their wages that they're, or the amount that they're being paid is treated in the same way as the girl that is employed on a Friday, as well as the factory foreman's wages. The idea is that we will not pay them based on the number of units that are being produced. They are paid a fixed amount and it is the same regardless of production. So that would be a fixed cost. And the last one is carriage on sales. And carriage on sales depends on the level of production. The more we are, so remember, carriage falls under the category of basically costs involved in delivering a product to a customer. So a lot of the time, if you have items that are being exported or sent to a different location within the same country. You have carriage fees that are being incurred. This will also depend on the number of units that are being sold. So if you're producing 10 units, for instance, and selling off those 10, then it would be a lower cost as opposed to if you are selling off 30 units, where the cost would obviously increase in that case. So here it is dependent on the number of units being sold or produced and sold. So it will be a variable cost as well. So now we have, from example 4.1, all of the costs included. We've put them into the categories of fixed costs and variable costs, and we added all of those up here and here. That gave us a total fixed cost of 20,000 Rand under the first column, and then the variable costs amounted to a much higher figure of 322,600. So here, your total cost, remember, is the sum of the two. So your total cost is the fixed cost total plus the variable cost total. So let's just put in the T so you know it's a total fixed cost plus a total variable cost to give you your total cost. So here we would add up those two, the 20,000 and the 322,600, and that gives you a total cost of 342,600. Now to use the figures that we had calculated here in your CVP analysis, in your cost volume profit analysis, we are first calculating, remember I showed you the formulas for your marginal cost ratio, your marginal income ratio, and then your break-even point. So here, the first thing we're looking at calculating is your marginal cost. Your marginal cost is, as a total, 322,600. To bring it to a per unit figure, we're going to divide it by the number of units produced. So remember, whenever you're bringing a figure to a per unit figure, it's always the total divided by the number of units produced. And in this case, it said to you that the company had budgeted to produce 200 units. So you're going to take the total of 322,600 from the previous page, and you're going to divide it by the number of units produced, which is 200 units, and that gives you a marginal cost per unit of 1,613 rands. So this is your marginal cost per unit. If you were to determine this value, and you can take this down somewhere on the side, if you were to determine this value as a ratio, it would be the marginal cost per unit divided by your selling price per unit. And we need to then, so that would be a percentage, marginal cost per unit over the selling price per unit multiplied by 100. So we know the marginal cost is 1,613. What is the selling price? And then we'd multiply that by 100. So here they said to you that let's assume that the financial manager, the company's financial manager, had decided to to sell the product at 3,000 Rand. So now you would take that 3,000 Rand as your sales figure. That would be your denominator. And so 1,613 divided by 3,000 multiplied by 100 would give you 53.77%. And I'll round that off to a whole number, so that would be 54%. So what that's saying to you is that 54% of your total sales needs to be attributed to your variable costs. Or it could be as a decimal, you would say 54 cents of every rand worth of sales is going to be paid or attributed to your variable costs. So that is your marginal income sorry, your marginal cost and your marginal cost ratio. We got the marginal cost as a rand figure, and then we also calculated it as a ratio here. Then we have your marginal income. So your marginal income now, remember, is the difference between your sales. So marginal income is your sales figure less your variable cost or your marginal cost. So 3,000 Rand is your sales figure. Your marginal cost we did at the top was 1,613. So that gives you a marginal income figure of 1,387. So now we have the marginal income as a rand value. Let's calculate it in terms of a marginal income ratio. So it would be marginal income over sales multiplied by 100. So here we would then have your marginal income of the 1387, that's here, over the sales of 3,000, and this is multiplied by 100, and that gives you a figure of 46.23%, which will round off again to 46, the whole number, closest whole number. So this now interpreted is saying to you that 46% of your total sales is going to be the contribution margin, or it's basically saying that after paying off all of the variable costs, this is what is remaining of the sales. This is the marginal income that remains. Or you can say that 46 cents out of every rand worth of sales is going to be attributed to your marginal income. So that's your marginal cost and your marginal income. And then on the next page, you're going to see the break-even point being calculated. So the break-even point is calculated using the formula in red here. It's your total fixed cost over your marginal income per unit. So your total fixed cost we got from this table at the bottom, the 20,000 Rand here. Your marginal income we had just calculated here. So it's a 20,000 divided by your 1,387. And this is 14.42. And you will always round it down to the closest number. Please make note of that. It'll always be rounded down to 14 in this case. So 14 units is your break-even point, saying to you that the business will need to produce 14 units in order for them to break even. If they produce more than 14 units, then they will make a profit. If they produce less than 14 units, then they will incur a loss. So 14 units is the break-even point. Then you have your break-even point in terms of rand value, or your break-even in terms of sales revenue. This is calculated using either one of the two formulas that we had seen. The first formula says to you, you can simply take your answer from here and you will multiply it by the selling price per unit. So when you're working out this answer, the break-even in terms of sales revenue, you will take the the decimal figure, not the rounded off figure. Take the decimal figure and use it in your calculation here in terms of your break even, and then multiply it by the selling price. So that's 14.42 multiplied by the selling price of 3,000, and that gives you a break even in sales of 43,260. Alternatively, if you use the other formula, it is the total fixed cost over the marginal income ratio. So your total fixed cost is 20,000 Rand, and I had already shown you on the previous page that your marginal income ratio would be your marginal income of 1,387 over the sales of 3,000, and that would give you more or less the same answer of 43,258.83. So that's your break even in terms of units as well as sales. Any questions there? So okay, so the last thing that we're looking at for today is just this last example, also based on your break even point. So at the top here, it's saying to you that since the break even point was 14 units, the business will need to make 15 units or more in order to make a profit, which is the same thing as I had written on the previous page. If they're producing more than 14, which is basically 15 onwards, then they would start to make a profit. If they're producing less than 14, which is basically 13 and below, they would then make a loss. Now, in this example, remember we said that this company was producing 200 units. So they were definitely meeting their break even point and they were definitely making a profit in this case. Now, another type of question that can come up in terms of your break even is where they would say to you that a lot of the time companies have targets in place where in a particular year there is a profit that they hope to achieve. They have profit targets in place, and we can also look at how many units a business will need to produce in order to meet that target. So here, if a business, and they gave you an example of, they said, let's suppose on average, this company wants to make a profit of 80,000 Rand. We want to know how many units do they need to produce in order to make that profit of 80,000 Rand. All you would do is to the break even formula. Remember, the break even formula is the one that says total fixed cost over the marginal income per unit. You're taking that same formula and to the numerator, you're just simply adding on the profit target that they hope to achieve. So in this case, exactly the same figures from the previous page, 20,000 over 1387. You're just adding into the numerator here the 80,000 Rand profit that they hope to achieve, and the rest is exactly the same. So 20,000 as a fixed cost plus the profit target over the marginal income per unit. This tells you that if the business hopes to achieve 80,000 Rand worth of profit in a particular month, they would need to make 73 units or produce 73 units. Now, again, here in this example, the company was producing 200 units already on a monthly basis, which means that they are more than reaching that goal of producing 73 units. And so they're definitely making more than 80,000 Rand worth of profits in a particular month. Okay, any questions here? Okay, so I'm going to stop here for today. When I see you in the next session, I think it's next week. I don't think I see you for finance for the rest of this week. When I see you next week, I'm going to do question 4.4 on page 117. However, please can I ask that you do attempt this question on your own. So please have a look at example, sorry, not example, question 4.4 on page 117 of your textbook. Please make note of it, question 4.4, page 117. Please attempt this, and I will also go through it with you in the next lecture, and I'll also go through example 4.4 in the next lecture. But this is basically the end of learning unit 4. It's just those two additional examples I'll be working with in the next session. And I'm also going to be doing one additional example over and above those two. I have already uploaded it to the case studies and activities folder. So please make sure that you download it from there. It is labeled Learning Unit 4 Costing. So please make sure to download that before your next session. I will stop here for today. This is basically the end of Learning Unit 4, and then I'll just do those additional examples when I see you again for this module next week. Thank you, everyone. Enjoy the rest of your afternoon, and I'll see you for stats. I think it's tomorrow.